So you've probably seen the ads, right? The fancy cars, the laptops on the beach, the whole dream of day trading. But what's the real story behind it all? Well, the data paints let's just say, a very different picture. We're going to take a hard, data-driven look at the harsh realities of day trading and see why so many who enter the arena just don't make it.
All right, let's just rip the Band-Aid off right away. This is the number you really need to remember. Study after study, looking at real brokerage data, they all land on pretty much the same shocking figure, 97%. That's the percentage of day traders who lose money over time once you factor in all the fees. And no, that's not an opinion. It's just cold, hard math. And it sets the stage for everything else we're about to talk about.
So, how do we get to a number like 97%? Well, it's not just one thing. Think of it like a gauntlet, the trader's gauntlet. It's a series of 5 brutal challenges that just systematically weeds people out one by one. We're going to walk through each of them. We'll start with the great trader washout, how fast people quit. Then the impossible math of coming back from a loss. After that, we dive into your own brain and why it's basically wired to betray you under pressure. Then we'll talk about how the game is, frankly, kind of rigged. And finally, we'll see what it actually takes to survive this thing.
Okay, first stage of the gauntlet, the great trader washout. This is all about attrition. I mean, where do all these aspiring traders actually go? The market is basically this giant revolving door, and when you see the stats on how long people actually last, well, it's pretty sobering.
Check out this funnel. It shows you just how fast the dream dies for most people. Within a single month, 40% are already gone. They've just quit. Fast forward 2 years, and a staggering 80% have washed out. After 5 years, you're left with just 7% still in the game. The key takeaway here isn't about making $1 million. It's that just staying in the game is a huge win in itself.
And if you think survival is tough, wait till you see the numbers on actual profitability. It gets even crazier. In any given year, only about 1.6% of all day traders can consistently make a profit after you subtract all the fees. And this tiny, tiny group is doing a massive amount of the trading volume. What this really shows you is that a very small, very skilled minority is basically thriving on the constant churn of everybody else.
Okay, so challenge number 2 builds right on top of this. Let's call it the impossible math of recovery. And this isn't about your feelings or having a killer strategy just yet. This is pure, brutal arithmetic. And it's a trap that so many traders fall into without even realizing it.
So first, let's get a key term down, drawdown. It sounds fancy, but all it means is the drop in your account from its highest point down to its lowest point. You're going to have drawdowns. It's a totally normal part of trading. But, and this is a big but, understanding the math behind them is absolutely non-negotiable if you want to survive.
This is where it gets really counterintuitive. See, the relationship between losing money and making it back isn't one-to-one. It's not symmetrical. A 10% loss? Okay, you need an 11% gain to get back to even. Manageable. But look what happens when that loss hits 50%. You've lost half your money. To get back to where you started, you don't need a 50% gain, you need a 100% gain. You have to literally double what you have left. Why? Because you're working from a much smaller pile of cash. This is the mathematical quicksand that swallows accounts.
And that brutal math is what kicks off this psychological death spiral. It goes something like this. Step 1. You take a big hit, maybe a 25% loss. Ouch. Now you feel this immense pressure to make it back fast. So what happens? Step 2. You start taking bigger risks, trying to make it all back in one trade, which of course often leads to step 3, even bigger losses. Now the hole is deeper, and that's when step 4 kicks in. Pure panic. You throw your entire strategy out the window and boom, the account is toast.
And that psychological death spiral leaves us right into the third part of the gauntlet, the battle that's happening inside your own head. Seriously, it's you against your own brain chemistry, and it's a fight most people have no idea they're even in. Let's talk about the neurobiology of why traders fail.
So, imagine you just took a massive loss. A switch literally flips in your brain. On one side, you have your prefrontal cortex. Let's call it the planner. This is the part that does logic, follows rules, and calculates risk. Well, under acute stress, it basically goes offline. It gets suppressed. At the exact same time, your amygdala, we'll call it the panic button, slams on. This is your primal fight-or-flight center. It's all impulse. You literally lose the ability to think straight, and your brain defaults to what we call revenge trading, which is about as destructive as it sounds.
Okay, so how do you know if you're in this state, this tilt spiral? Well, here are 3 classic warning signs. Number 1, you get stopped out of a trade and immediately jump right back in out of pure anger. Number 2, you double your position size on the next trade to win it all back. And number 3, that carefully crafted trading plan you made when you were calm, yeah, you just toss it right in the garbage. If you see yourself doing any of these, that's a massive red flag.
And what's driving all this crazy behavior? Well, a lot of it comes down to a fundamental glitch in our mental wiring called loss aversion. We are programmed to feel the pain of a loss about 2 to 2.5 times more powerfully than the pleasure of an equal gain. And this causes the single biggest mistake in trading. We cut our winners way too early just to feel that little bit of pleasure, and we let our losers run and run because we're desperately trying to avoid feeling that intense pain of being wrong.
So we've talked about the math that works against you and the brain chemistry that works against you. Now let's talk about the fourth challenge, the game itself. The market is not a level playing field, not even close. Retail traders are walking into a world full of structural traps and massive institutional advantages.
Just look at this comparison. It's really two different worlds. You, the retail trader, are working with public data and a home internet connection. They, the institutional trader, have privileged data and their servers literally in the same building as the exchange for microsecond speed. You're paying wider spreads to a broker? They have direct access to the market. You have limited capital? They have things like dark pools to hide their huge orders. From the second you click buy, you are playing a fundamentally different and harder game.
Okay, let me give you a super specific example of a trap that catches so many people. First, you need to know a word, contango. All it means, especially in markets like oil, is that the price for a futures contract down the road is higher than the price today. You can just think of it as the market charging for the cost of storing that thing for a month.
So who cares, right? Well, you care if you've ever bought a popular commodity ETF. See, that fund doesn't actually own barrels of oil. It owns futures contracts. And in a contango market, it's constantly forced to sell the cheaper contract that's about to expire and buy the next, more expensive one. This process, called rolling, is like a constant hidden tax on your investment. It's a financial drag. And this is mind-blown, an oil ETF can lose 24% in a year even if the actual price of oil goes nowhere.
And believe me, these hidden traps are everywhere. If you trade options, you have to worry about IV crush, where your options value can just completely implode after a big news event, even if you are right on the direction. In crypto, you have these insane liquidation cascades, where one person getting a margin call triggers a domino effect to force selling. And then you have all these offshore platforms that lure people in, not realizing they have zero regulatory protection. When things go wrong, your money is just gone.
Okay, so after all of that, you're probably thinking this is completely hopeless. And, well, it's really, really hard. But it's not impossible. That brings us to our final section, surviving the gauntlet. We've seen why most people fail. Now let's touch on what that successful minority understands that the rest do not.
It all comes down to this one core idea. This is the mantra of anyone who survives long-term. Your number one job is not to get rich. Your number one job is to survive. Capital preservation is everything. If you can keep your drawdowns small, you can always fight another day. But once you let a loss get to that 50% mark we talked about, coming back isn't just difficult, it becomes statistically improbable.
So in the end, the secret sauce that separates the winners from the losers isn't some magic indicator they bought online. It's not a perfect can't-lose strategy. It's the boring stuff. It's the disciplined, consistent execution of a plan. It's the mastery over those neurological impulses we talked about. And it is a relentless, mathematical focus on managing risk above all else.
And that leaves us with a final question for you to consider. The market is a ruthless arbiter of discipline. It doesn't care how smart your strategy is on paper if you can't execute it consistently under pressure. So ask yourself, are you trading a statistically validated edge? Are you just trading a deeply held belief? The answer makes all the difference.